the Treasury Secretary did say that investors should not be concerned about this. But how have the markets performed in the past during similar times of stress in D.C.? We asked Dominic Chu to take a look.
Wall Street has not generally reacted well to fiscal uncertainty. In the last decade, there have been numerous cases where market volatility was the result of budget and debt ceiling impasses. One happened in the summer of 2011 when lawmakers were stuck in negotiations that could have led to a government shutdown. Ultimately, the worst was avoided, but concerns over America's future fiscal path led credit ratings agency Standard & Poor's to cut its rating on the U.S. for the first time in history. And let's not forget the European debt crisis was raging at the time market volatility surged. In the fall of 2013, the government shut down. The week before, markets were weaker. During that same time period, lawmakers were also grappling with the validity of the Affordable Care Act. And at the end of last year, a budget impasse led to the longest partial government shutdown in U.S. history. At the same time, investors were concerned about interest rate policy from a Federal Reserve that looked to tighten financial conditions. In each of those scenarios, there were two common threads. One, that fiscal policy was surrounded by other negative market catalysts in play at the time. And two, when a resolution was reached eventually, the initial volatility smoothed out and the markets ended up higher. For Nightly Business Report, I'm Dominic Chu.